Welcome everybody to the Halftime Update 2026. We got a lot to talk about, so I'm just going to jump right in here. I always start with a quote of the day. This is Charlie Bolello. I just thought this was really interesting. 5 months ago, it was said that the dollar is doomed and silver and gold are going to the moon. And in reality, since then, when Charlie wrote this quote, in reality, the dollar was actually up 7% since this was said. Gold was down 26%. And silver down 50%. So I think this is just another one of those things that teach us that whenever you see something on the news, on the internet, don't necessarily believe everything you read and don't believe everything you see. So let's talk about the U.S. stock market first, the S&P 500. We have what we're looking at is kind of a triangle pattern here. I'll show you in a second. But we have a rising 200-day moving average, so we're in a long-term uptrend. We've broken out to all-time highs after the Iran war bottom down here in spring, and things are looking pretty good right now. They're just kind of digesting. If we look at momentum in the bottom pane here, this is relative strength index, so RSI 14. One of the things I noticed was that while we're in a bullish regime, which means that we crossed above 70 here multiple times actually, and we did see a pullback, it pulled back to 40. And typically when we see bullish environments in the market, or any investment for that matter, when momentum declines, we like to see it hold above 40. Now crossing below 30 would be a bearish regime, but really 40 kind of shows that it's still really holding up strong. Then we have the triangle pattern I was talking about here. I put this in our monthly market brief yesterday, actually. And by the way, I'm recording this on Thursday. So this is consolidation. Some people might call this a continuation pattern. Typically when you could almost call this a pennant. I don't think it is, but this is a symmetrical triangle in the making. And typically what it means is that we really shouldn't do anything at all. Just kind of sit around, wait, and see what happens. If it breaks down, that could be a problem. Our next line in the sand would be right here at the top of these highs in the beginning of the year. And if it breaks out, then that would obviously be a good thing. Now we have the small cap index, and we bought into the small caps back in early December. So I believe it was December 13th. And the reason we bought into it was because there's just this long, huge, multi-year ceiling of potential resistance that sat here going back to late 2021. And when it broke out, pulled back and held that line in the sand and headed higher, the evidence was very strong and we were basically stacking the deck in our favor. So small caps look very, very good. When we switch gears and we talk about international stocks look good as well. Obviously, when you have a dollar that's starting to do well, and we'll get to that in a second here, it puts a headwind in front of international stocks. So it makes things a little tougher, but they're still ranked very high. Both U.S. and international stocks are almost neck and neck going down the straightaway here, metaphorically speaking. But when you compare the U.S. to international stocks, and international stocks are in the numerator here. So when this is going down, that means international stocks are not doing as well as U.S. stocks. And when it's trending up, that means international is better than U.S. stocks. And you can see here, going back to early 25, we kind of had this big jump, and then it kind of consolidated sideways. Early this year, we had this jump in the relationship where international was the place to be. Part of that was a dollar story, but now it's just kind of gone back into this no man's land of consolidation. So again, I don't think you can go wrong right now owning international or domestic, just depending on what you own. But that's the key, just making sure that what you own is good stuff, stuff that's trending up, that has momentum, investments that have relative strength, and so on. If we look at the U.S. dollar, I mentioned I was going to bring this up earlier. We saw the U.S. dollar hitting lows over and over and over and down here. And then all of a sudden we see this breakout, kind of an intermediate term breakout. We also have a rising 200-day moving average or a rising 200-day trend line. That's good. So far the dollar is starting to look stronger, not strong, but stronger. And that's, again, one of those kind of caution signs when looking at purchasing international stocks, because if the dollar goes up in value relative to international currencies, then all things held constant, those international stocks that we might own over there might not do as well as a result. Now let's talk about bonds, fixed income, treasuries. This is the 20-year treasury bill. Still looks terrible, still underwater. This is going back to COVID. It's just hard to imagine looking back to COVID when, TLT here, long-term treasuries were trading in the high 100s, 173, 176 per share. And now they're floating around between 85 and 87 per share. So still kind of a no-touch. And now that we're starting to hear grumblings out of the Fed that they, instead of cutting rates, they might actually raise rates. Raising rates is not a good thing for bonds. When rates go up, bonds go down in value and vice versa. So it's starting to look like, most bonds are struggling, and we're actually starting to see cash, or in other words, money market rank north of almost all bond sectors, and with very rare exception, this being one of them. So this is the convertible bonds. Convertible bonds are still doing very well, although there is a high correlation with the stock market when you're looking at convertibles, but this is one of the bright spots in the bond market, even though one might say that I'm kind of cheating here because, again, there is a very high correlation with convertible bonds to stocks. Let's talk about commodities. Something really interesting when you look at gold, silver, and the dollar. Again, there was silver, gold was doing so well for, I don't want to say so long, but it was just really, really bullish. And now what we've seen this past 5 months is the dollar up, gold down. So I mentioned that earlier, and this is as of June 30th, so a couple days ago. So really interesting chart here from, again, Charlie Bolello. Gold futures, so this is an actual gold chart. Gold is now underwater if we use the 200-day moving average or 200-day trend line as our line in the sand for what would be considered water. It's not looking like it's trying to bounce back here. It may. Anytime something goes down fast or up fast, it has a tendency to be reflexive. You might see like a bounce. It could be a dead cat bounce, but the bottom line here is in order for gold to be considered a good, solid investment in the intermediate term, we need this thing to get back above this line in the sand and hold it. But right now, it's not looking so good. Silver, same story. Went below water, came up for air for a few days, and then went right back below it. So silver and gold, not really something I'm interested in right now. Oil, it's been a fun ride. The Iran war caused a lot of fear in the market when it came to supply and demand and oil and shipping, among other things. And as you can see here, the price of oil is right back down to where it was before the whole thing started. So hopefully we'll start to see that reflect in our gas prices, right? I'm sure they'll be rushing to the tank to lower our prices. I'm sure they will. Hashtag sarcasm. Let's talk a little bit about risk here. A couple relationships I'm going to share with you, kind of like the international versus U.S. stock risk comparison or relative strength chart, relative comparison chart. Here we're looking at discretionaries versus staples. Discretionaries are luxury goods, things that we buy because we want them, not because we need them, whereas staples are things we need. We need to have them whether things are going good or bad. So what happens is when this chart is going up, then discretionaries, so luxury goods, are doing better than staples, which are, again, things we need. And when this chart is trending down, then it means that the things we need are trending up, or in other words, they're on a relative basis, they are better. When we want the market to be bullish, right, we want stocks to go up. What we want to see is this chart trending up. And what we see right now is kind of a big dip below water thanks to the Iran war. And it's been kind of trending up in the short term, but it's still below water looking at that 150-day moving average. Another similar comparison, just looking at two sectors in the market, one that's offensive versus one that's defensive. Technology is very offensive, obviously. Utilities is a defensive sector, so same story here. If it's going up and to the right, that means technology is better. If it's going down and to the left, then that means utilities is doing better. As you can see pretty clearly here, technology is outpacing utilities, which again is bullish for the stock market. This one is just for fun. This came from the chart report, and it's basically the leisure and entertainment sector and breaking out to new all-time highs. And when we look at the stocks or just the stock market in general, and we're concerned or we're fearful or we're worried about the market crashing, let's just say, I don't think that seeing leisure and entertainment stocks is necessarily a sign that the market's going to crash. I mean, when you start seeing this stuff go up, break out to new all-time highs, and in this case, breaking not only out to all new all-time highs, but out of a big wide range, I think that's probably a really good thing for the market, not so much evidence that the market's going to crash tomorrow. This is a long-term ranking system. Basically, it's looking at the major sectors in the market and asset classes. And you can see here, small caps are the winner, pole position, so very, very, very strong ever since December. Then second place goes to international stocks, third place to commodities, fourth place to U.S. stocks. And they're almost like neck and neck here, all three of them. In fifth place is cash, money market, and in the basement are long-term treasury bonds. So we kind of know they aren't doing so hot. There's your proof. This is another ranking system using what's called a point and figure chart. A little bit more confusing. I'm not going to go through all of it. Just focus on the left side here to basically say that, again, like I mentioned earlier, international U.S. stocks are kind of neck and neck. Again, I won't get into buy signals and what they mean. There's too much to explain for this particular presentation. But 307 buy signals for international equities, 301 for domestic. You can't get much closer than that, obviously. So both of those top asset classes, commodities number 3, but a distant third place. Let's talk about digital assets. So cryptocurrencies, Bitcoin is not looking so hot. You can see the peak here. This is Bitcoin all the way down to where it trades today. Underwater, it keeps trying to come up for air, and it just can't seem to get above that 200-day moving average. Ethereum doesn't look all that much different. I'll show you that in a second, but these are declines going all the way back to the beginning of Bitcoin. And you can see here some of the big declines that have happened: down 94, down 72%, 94, 85, 84. The most recent biggest decline, 2022, 78% from top to bottom, 28, 17, and 18 down 84%. But right now where we're at, and this is as of last month, 53%. So we're gonna have to see what happens here and how long this is gonna take, and if things are gonna turn around anytime soon. Like I mentioned, Ethereum's not looking so hot either. And well, they don't trade in lockstep. Sometimes Ethereum is stronger than Bitcoin and vice versa. I typically will pull up a relative strength chart comparing those two when we're doing these presentations, but there just isn't any need to do that since both aren't doing hot anyway. I wouldn't want to own them anyhow. Big picture. So as we go into a close here, I found something really interesting. This is from Meb Faber. I just thought this was really cool. If you go back to 1900, these were the industry rating and industry weights in the stock market back then. Look at how much rail was a percentage of the stock market as a whole compared to where it is now, which is 0. It's in the other category. So technology is the biggest weighting, then industrials, healthcare, retail, financial services, banks, and so on. So just really interesting to see how different things were 126 years ago compared to how they are today. Another thing that I know people have been talking a lot about, SpaceX, the IPO that just came out. This is the average 3-year annualized total return of IPOs versus the overall stock market. And I think that the point I wanted to share here is that people get so excited about IPOs, but the performance isn't even as good over 3 years from when they open compared to just the overall market in general. And this is going back to 1980. And so you can see here, total return since the inception of the IPO ETF in October of 2013. And you can see here the IPO ETF that owns IPOs, right? It's the lowest performer compared to the NASDAQ and the S&P 500. So what that tells us is that it's fun to get excited about IPOs, but they aren't necessarily the best investments in the world. Speaking of investments that have been around a long time, and there's some bad stuff going on in the market right now, Nike is going through their worst drawdown in history, down over 75%, believe it or not. I don't know if nobody's buying their shoes or what's going on here, but bottom line is probably don't want to own Nike. Looking at margin debt, this is one of the things we start looking at when markets start to get a little frothy or long in the tooth. When margin debt starts to get high, especially when it gets above 50%, that's when we tend to see pullbacks in the market, consolidations, choppiness. You can see here, got above 50% back in 2020 during the COVID drop, or before the COVID drop, I should say. And we're just above that 54% right now. And you can see, obviously, this happened, of course, before 2000, the dot-com bubble, as well as the Great Recession, mortgage crisis. So something to pay attention to, something to keep our eye on, of course. This is a chart that just shows the number of buy ratings among Wall Street analysts. And what I found interesting, this is again from Charlie Bolello, this is nearly 60% of the stocks in the S&P 500 now carry a buy rating, which is I believe the highest of all time. So again, kind of frothy, maybe long in the tooth, but this is a risk on-off indicator by Sentiment Trader. And what this is telling us is that we're risk on. So there's some mixed messages out there, but we have to follow the weight of the evidence. We don't use one indicator. We don't use one sign, one trigger to determine if we're going to be bullish or bearish, whether we're going to be invested or not. We use the weight of the evidence to put together a picture of the crime scene, so to speak, and determine how bullish or how bearish we want to be. And it's always a dimmer switch, not an on-off switch. And speaking of fear, earlier I mentioned that, let's go back here real quick. So, things getting frothy here with margin debt, I mentioned a second ago, but analyst ratings, nearly 60% carrying a buy rating. But when you look at the market as a whole, when you look at market participants, investors as a whole, they're still fearful. 31 a week ago, 24 is where it was. So I don't want to say it's impossible, but it's pretty difficult to see a big decline in the market when people are generally fearful. Usually it's the opposite that happens. You tend to see people get greedy, and we start to see this meter get up to extreme greed, and that's when we start to see pullbacks take place. This is the Stock Traders Almanac 4-year presidential cycle. You can see here where we are here this year in 2026. And then when you can look at the all midterm election years, and they tend to be pretty weak, starting in April, going all the way through the end of September, even beginning of October, before seeing positive numbers through the end of the year. So this is going back to 1971, and the market's been kind of bucking the trend so far. So things aren't doing so bad, but we could see some choppiness here, as we've already seen some consolidation as it is. This is my pre-flight checklist. This is a big, huge dashboard of a ton of indicators. And because I'm colorblind, I have everything recoded that I can anyway. Older color system isn't coded for red and blue and green, obviously, but I have it coded for red and blue. Blue is good, red is bad, and what we want to see is mostly blue up here. So most of the trends are up, short-term, intermediate-term, long-term, across the board, both with the S&P, NASDAQ, and so on. Small caps look good as well, so this is pretty good. Then we have the inverse traffic light chart of the S&P 500. We're pretty solidly in the green here. The yellow sits at the bottom of the most recent lows. And then the red zone, the caution zone ends and the danger zone begins at the bottom of the Iran war. So where the bottom took place before things started running up. And then we have, of course, defense, as the saying says, Bear Bryant, I believe it was, who said that defense wins championships, offense sells tickets. I said that backwards. Offense sells tickets, defense wins championships. But when you lose money, it doesn't take an equivalent amount to make that money back. So you lose 10%, it only takes 11% to get back to even. You lose 20, though, it takes 25% to get back to even. You lose 30% of your money, it takes 43 to get back to even. 40% loss, 67% to recapture your principal. And of course, the easiest math, you got $1 million portfolio, you lose 50%, you've got $500,000. If you make 50%, you only have $750,000. You got to make 100%, or in other words, that $500,000 has to grow another $500,000 to get back to where you started, and it just gets worse from there. So risk management is always number one. We always got to be paying attention to what's going on and what could be coming around the next corner when things are going well, and things are going well right now for the most part. So if you have any questions for us, feel free to reach out. You don't have to be a client to ask a question. If you'd like a second opinion on your portfolio, if you'd like a second opinion on your retirement plan, your financial plan, please reach out. I always say I haven't worked in 25 years. I love what I do for a living. I love getting up and coming to work every day. And we would love to share that passion with you. If you have any questions at all, again, you never have to be a client to ask a question. Thanks so much for watching, and we'll see you next time.